All right, so you're thinking about buying some stock. You're bullish on stock. A call option is not really much different. You're bullish, you think the price is going to go up. You can buy options on many different stocks, indexes, futures, so on and so forth. And it means that you're bullish. You're going to buy the call option with the understanding that it's going to go up. But there's some factors that influence call options and call option prices. Unlike a stock, when you buy it, you hold it and you hope that it goes up. A call option has several different factors. There's 6 different factors that influence a call option's price. We're going to jump into that, but basically, at the simplest form, a call option is a bullish strategy. All right, so looking at the different factors that influence an option's price. You have stock price. This is pretty simple to understand. Basically, the more expensive a stock is, the more expensive the call option is going to be as well, or the cheaper the call option. That's pretty straightforward. Strike price. There are different contracts. There's several different contracts on these different options. When you think of a contract, you're not signing any kind of paper or anything like that. You're basically just going to find a strike price, which you establish these contracts. The minute I buy it, I'm in a contract. The minute I sell it, I'm out of the contract. It's very simple. I'll show you on a platform here in a second. But if you have a $100 stock, you may have different strike prices. You may have a 99 strike, a 98 strike, a 97 strike, 96, 95, so on and so forth. Same thing, you can even north of that price. So 101, 102, 103, 104, you can have different strikes for these call options. We'll get into that in a second. I'll show you on the platform what those strikes are, but strike price will influence an option's price. The deeper in the money you go, if the stock is selling for $100 and you go down to 90, it's going to be more expensive than the one that's maybe 95 or 100 or even 105 or 110. Those prices are going to be different. So a strike price influences the call option price. Expiration. When is the contract good for? Is it good for 7 days out, a month out, a year out, or maybe even 2 years out? The further out you go with expiration, the more expensive the option is going to be because there's more time in that option for it to arrive at a certain point in price. So you're going to have a bigger time factor. Interest rate. What's the risk-free rate? Usually it's the 10-year rate that we're talking about. 10-year rate doesn't change that often, but it does influence the call option's price. For most purposes, it's not something we really consider because it's not going to influence it that much. Same thing with dividend. What's the stock pay in terms of dividend? Does it pay monthly, quarterly, yearly, whatever? But a dividend rate also affects call option prices. It's not a big factor, so it's not really something that is really worth considering unless you're buying tons and tons. But for the average retail investor, a dividend rate does not apply significantly to a call option price. So the first 5 are observed. You can see that. Volatility is not observed. Volatility is what the market thinks the price or what the stock could move to. So if there's a big event like an earnings event or the Fed's getting ready to speak, maybe it's FOMC day, those events, people will buy and pay more for options because the stock could move more. The expected move is higher. So they're going to buy options to protect their risk. Maybe it's an upside risk that they're worried about or downside risk. They can buy options to protect either one of those sides, and they're going to pay a little bit more. Volatility is that expected move, and it definitely affects a call option price. If volatility is higher, call options are going to be more expensive. If volatility is lower, call options are going to be cheaper. There's a thing out there called volatility crush. Let's say it's earnings. Everybody's expecting a big move at earnings. Volatility is going to be more expensive, and therefore the call option is going to be more expensive. When I say volatility is more expensive, it means it's higher. Those two terms are used interchangeably. So when volatility is high, the call option price is going to be high. Let's say right after the event is earnings, right after that volatility is going to drop because everything is known. Maybe something like Netflix. Are the subscriber counts going up or down? So there's going to be a lot of volatility, and there's going to be a lot of volatility priced in that premium. The minute everything is known, volatility drops. It's called volatility crush. The stock could actually go up a few dollars. But volatility, because of volatility crush, the call option price might actually drop because volatility fell a lot. So people aren't willing to pay as much for that insurance or whatever they're trying to protect. So volatility is a very important factor in influencing the price. A couple other things, you have ITM, ATM, OTM, that's basically in the money, out of the money, and at the money. Those are where the strike price is relative to the stock. If you're looking at a call option, and this is the strike, this is the at the money, this is the price, let's say it's $100. These strikes up here are going to be out of the money. These strikes down here are going to be in the money. And the deeper you go, deeper in the money. That's pretty simple. And these are your OTMs. Okay, we'll get into that in a second. I'll show an option chain. A couple other factors that are super important. Delta. Delta is very important. It represents your percentage chance that the stock is going to expire above that strike price. So if you had, going back to this example, if this is $100, the deeper you go in these strikes, let's say this is $80, your delta is going to give you a percentage chance. It'll be like 0.8 or 0.9, or these factors will change, but that 0.8 would be, it's an 80% chance of it expiring above $80. The other part of delta, you can use the same exact number, multiply it by 100, and it's going to give you an equivalent stock position. That also represents 80 shares. It could be 50. It could be 20. It could be anything really between 0 and 100. And each contract will have a delta associated with it. And that will, at that moment in time that you execute it, will represent 80 shares. So if it went up by $1, you're going to make $80 because the delta was 80 and it represents 80 shares. So it's going to go up by $80. I'll show you that on the platform here in a little bit. Delta does change over time, so it's something worth keeping an eye on. Intrinsic value and extrinsic value. Intrinsic value is anything other than time. So going back to that example, if I have a $100 stock and I buy an $80 strike, my intrinsic value is going to be 20 because the stock price is here, strike price is here. It's just the difference in between these two. The intrinsic value is going to be 20. However, the time value could be something greater. The time value might be something like, depending on how much time is left, it could be another $10. So the call option price might be $30 for a $100 strike. It could be different. It might be $5. It's basically anything that represents the time. The more time there is, the more expensive this piece is going to be. If you're a day or two out, there'll be no time value left. And I'll go through that here in a minute. Here's your profit diagram. This is what this will look like if you were to buy a $100 call. Let's say that $100 call is selling for $4. Multiply that by 100, it's $400. I can buy the stock outright, and this is what my profit diagram would look like. If I buy it at $100, if it goes up by $1, then I'm going to make the difference between there. This is a $10,000 investment, by the way, because I'm buying 100 shares. So if it moved up to 101, this is a $100 profit. This is $200 profit. This is $300 profit. So I'm buying, it goes up $3, great. I made $300. The inverse is true. If it goes down by $3 or $4, I'm going to lose. If I go all the way down to say $90, I'm going to lose $1,000. Okay. A call option works like this. If I buy a call, and let's say I buy it for $400, and my strike price is 100, and it's 30 days away from expiration. If the stock stays here for the entire 30 days, my call will become worthless. If the stock moves up this direction, if the expiration date, the price is at 104, That's my break even, because I've got the stock has to move enough to overcome what I paid for the call. I paid $400 for the call, so the stock needs to move at least to 104 to overcome the premium. If I move beyond that, then I'm making money. So let's say this is 108. Whoops. This is $108. At this point, at expiration, the stock is 108. I have made now $400 because I paid $400 for it. I passed my break even, and now I go up to here, and now it's worth, the option is going to be worth $800. But I had to pay $400 for it, so my profit is only $400. Whereas the stock buyer, if it went all the way up to 108, he would have made $800 in total. Where this is valuable is if it continues to go up. Another way this is valuable is I paid $400 to hold $10,000 worth of stock. So even though right here I only made $400, whereas the stock buyer made $800, I've actually doubled my return because I only paid $400 and I made $400. So I had 100% return, right? I did that wrong. I had 100% return because I paid $400, I made $400. This guy here spent $10,000, made $800. Okay, he only made an 8% return. So this situation here, I doubled my money. This guy here only made 8%. Now, going back to our example where it fell, this guy here lost 1,000 if it goes down to 90 because he spent 10,000. Now it's only worth 9,000. He lost $1,000. The call buyer only lost $400. He lost, though, 100% of his investment because he spent $400. It dropped. Now, if it drops down, let's say this drops all the way down to $50. Guess what? I'm only losing $400 because the only thing I paid was $400. The guy that takes it all the way down to 50, he lost $5,000. So he lost 50% of his investment. And it's a whole lot more than the guy who lost 100% of his investment, but he only lost $400. So he's still got money to play with to go do something else. So that's how the profit diagram works. This is probably the most difficult thing I'll show you. Let's say the price is at $50. This is a $50 stock. This is a July call, a July $50 call. If the stock goes down to 30, the intrinsic value is nothing of the call option. But the call option still has time. There's a time component to this. So if I'm down at 30, this might be worth maybe $1. The $50 call is going to be worth $1. If the stock is up to 50, this might be $4 or whatever the price is. It depends how far out we are. But for the example, we're saying, hey man, we're like six months out, maybe 3 months out. This will be selling for $4. This just for illustration. This is where the most expensive, it's right at the money is where the time value is the most expensive. Let's say the stock keeps going up and we're at 60. Your intrinsic value is now $10. 60 minus 50, our strike price. This is the strike price. This would be the stock price. The intrinsic value is 10. The time value might be $2. It gets smaller. It might only be $1. If I were to go up further in price, and let's say this is 80, and the stock now is sitting at 80, my intrinsic value is going to be 30. 80 minus 50 is 30. But my call time value might only be 50 cents or maybe 25 cents. This is what they say. I'm trading close to parity. And the delta on that is going to be around 90, maybe 95. As I go up, no matter what, the call is now equivalent to holding the stock. So if it goes up $10, the call option is going to go up $10. Okay. If I'm back at this point and the call drops, the stock drops, the time component is going to not drop as fast because the delta is going to get lower and lower. So basically going back to that equivalent stock position, This would be up here, is going to be worth 95 or 99, something like that. And it's going to move like as if though you hold 95 shares. If you get down here, the delta might only be like 20. So then it's going to be the equivalent of holding 20 shares. So you're going to have to move a lot in order to get you're going to have to move $5 to get, say, 20 times 5 is 100. You're going to only have to move a little over $1 to get the same value. I hope that makes sense. The illustration here, though, is at the money is where it's all time value. As you go in the money, and your stock is maybe 55, as you go in the money, your time value gets cheaper and cheaper, but the intrinsic value goes up. Anything less than 50, there is no intrinsic value. It's all time. Okay, speaking of time, the reason why time is so important is there's a Greek out there called Theta. Theta is a call option's worst nightmare, because a call option will eventually expire worthless, or depending on where it's at, if it's in the money, out of the money. But if it's at the money, it's going to expire worthless. If it's in the money, you're going to lose the time component. So this becomes extremely important. Time is everything. So let's say you're 90 days out. The time, we're not going to talk about intrinsic value. Let's say you have that $50 call and the stock is sitting at $50. This might be sitting at $4. That's the value of that call. If in 90 days the stock does not move, here's 90 days, 90 days out, we move forward 90 days, so we have 0 days to expiration, and the stock is still sitting at 50, this is what's going to happen, all things being equal. The time value is going to shrink. Once you hit that 45-day mark, 30-day mark, it accelerates very quickly. This is a option seller's friend. It is an option buyer's nightmare, because you have to pay attention to time and how much time is left. Because if you bought this for $4, let's say you had a few of these contracts, you're paying $400. Let's say you had 10 of them, you're paying $4,000. If the stock doesn't move, the value of the option is worthless. So you're going to lose $4,000. In order for that to make money, though, you would need the stock to move to at least $54 at expiration to overcome the costs of our option. And then anything above that, that's your break even. So anything above that is profit. Again, you're holding 100 shares for each contract. If you were to do this, you would have held 1,000 shares. So the math is true. Even if you go to $60, you're still going to be profitable. 60 minus 54 is 600 per contract. And if you had 10 of them, that's $6,000 profit. But you did that on a whole lot less money than you would have if you would have just bought the stock outright. But this is the time component. Bottom line here, time is a killer of call option when you're buying it. So pay very close attention to that. All right, why buy calls? You got limited risk. We went over that a little bit ago. We can hold 100 shares very cheaply. You can leverage up a lot. A lot of people like buying calls because I can own the stock for a whole lot less. I can own I don't own the stock. I'm owning the right to buy the stock, and I can hold hundreds of shares for a lot less. The risk with calls, though, is I got to be right, but not only, I got to be 110% right, because I've got to overcome the value. Going back to that $4, I have to move to $54 just to hit my break even. So I have to be right, and I not only have to be right in the direction, I have to be 110% right in the direction that I have to overcome the price of the option. So with that, let's go take a look at a couple of examples in Thinkorswim. What I'm looking at here is DHI. DHI for 13 days out. I'm going to illustrate just a couple of concepts here that we talked about. Look at the price of these options. These are your strike prices. This is in the money. This is out of the money for calls. We're only talking about calls. These are puts. For today, just look at these calls. So I'm in the money. If I'm $4 in the money, here's my price, $131.90, right up here. So I am in the money, $4.90. That call option is worth, I'm just going to use these ask price. I'm always going to go in between bid and ask, but we're going to use the ask for the example. It's at $6.30. You can tell that there's not a lot of time left because the intrinsic value alone is $4.90. That means there's $1.40, 630 minus 490 is $1.40. That's all that's left is $1.40. So if I were to hold this to expiration in 13 days, it's only going to lose $1.40 because I'm going to, no matter what, my intrinsic value is $4.90. So it's only going to decrease to $4.90. So the goal is that I want the price to rise. Here's my delta. There's a 68, 69% chance that it's going to expire above 128. That's already calculated for me. If I were to go deeper in the money and go to a 125, now at 840, I've got, let's see how much time value I have. So 125 to 130, 190, $6.90. I've got $1.50. Now, this is after hours, so you would actually see this price drop. It's going to have a lower time component than these up here. All of this, if I were to buy 132, look, I have no intrinsic value. This is all time. So it's almost $4. My example earlier, so $3.70. The stock has to move to 135.70 in order for it to become break even. It's not even profitable. Now I got to move it beyond that in order to become profitable because I have to get to the 132 plus the 370. That's the time that I'm buying. If I make but I'll say this, it's only costing me $370 to hold the possibility of owning 100 shares. That's a whole lot cheaper than the 13,000. If the price goes to 140, I've overcome the 370 because I got to get to 135.70. So that means I've made $4.30 if I get to 140. So if I've made $4.30 per contract, that's $430. It cost me $370. I've doubled my money. The odds of it getting there, though, with all things being known, is 20%. You can see that delta is 20%. All right, let's look at something else. I'm going to go a little bit further out. Let's go almost 3 months out to September. Let's look at the value of the calls. They're much more expensive. I can buy a $130 or $135 call instead of the $3 that we saw earlier. Now I'm having to pay $7. So now the stock has to move to 142.80 to be exact, in order to be profitable by September. Now I can buy this, and here's my delta is 50, almost 50%. 50% chance that it's going to expire above 135. That's all that's saying. But it's also saying that it's the equivalent at that moment in time that I am buying 50 shares of stock. So if tomorrow I bought this and it goes up and I have everything being equal, no volatility crush, nothing, everything being equal, the next day you could expect to be, if it moved up by $1, this is going to be $50 profitable because it's the equivalent of holding 50 shares. 50 shares moving up $1 is $50. Now you're going to have a little bit of time decay, 1 day's worth, but you're going to have time decay. So it won't be quite 50. And if you had volatility shrink, it could be even less. That's where volatility and time is so important, because if volatility collapses or time collapses, the call option price will collapse as well. So that's where I'm saying you have to be right 110%. The further out you go, let's go all the way to elite. Anything over about 1.5 years to 2 years is considered elite. It's just a call option that's just a long dated call option where you have very little time decay. So I can buy at the money for 26. So $2,600, I can hold roughly 61 shares of stock. So this is a much cheaper way. Instead of buying 61 shares, which would cost me nearly $7,000, I can buy 61 shares for $2,600. And I'm going to have very little time decay because I'm so far out. If you don't want any time decay at all, why don't you just come down here? This is a cheap way of buying the stock. I can buy nearly 100 shares, the equivalent stock position, 92 shares for $7,600. That's pretty sweet. I can buy $13,000 worth of stock for $7,600. So I'm buying it half off. And I have very little time decay. It will work exactly like holding 92 shares. I've got 559 days, almost 2 years before this thing expires, so time decay is going to be very small. In fact, here's your time decay. There's theta. And look, this is how much it's losing per day. Very little. Whereas if I go back to my 30 days, let's go 30 days out. Here's 141 days out. And look at my theta for at the money. I'm losing nearly $8 a day, all things being equal. Now, let me do this. I'm going to go ahead and buy one just to show what this looks like. There's my probability, 62% that it's going to be profitable, 38% that it's going to be profitable. There's my profit diagram that we looked at before. Here's one contract, $11 or $1,100. And I can click over here to my table, and there's my break-even points. I was giving you a lot of break-even points just off the top of my head, but the table will calculate it for you, so you know exactly what you're getting into. But I've got to be above $136 by August 15th for this 125 in order to start becoming profitable beyond that date. Now, it'll be profitable tomorrow if it goes up to 136 because the time didn't shrink. So I hope this helps. If you like this video, please let me know. Let me know what else you'd like to see and put it down in the comments. If you have any questions, please reach out. Happy trading and have a good one.